chasing money, chasing this, chasing that, like at the end of the day, it doesn't really matter. Like you need money to survive, you need to
Correct.
provide for your family and that sort of thing. But ultimately, like family is the number one thing.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
All right. Hey, welcome back. Happy to have you here today. Got Kyle Church on. He is a professional, a financial professional. He helps people secure life insurance policies and financial products that allow them to do some estate planning and that sort of thing. So I thought it'd be helpful to come on and share some of the strategies that he uses with some of his clients. He's also a police officer in the San Francisco area as a full-time gig, and solid guy, great energy, and you're going to get something out of the show. If you would go and rate and review wherever you are, one word comment helps us a ton, more so than the star. So it helps us get reach and get great guests to come on the show to provide as much information and value as possible to you, the listener. So appreciate you again jumping on and everything that you guys do to support the show. Without further ado, here we go with Kyle. So what are you working on? Because I was looking and you had like a podcast, so I went to look for it. I couldn't find it. I don't know if I was
Yeah.
typing the wrong thing in. And so I'm like, all right, what is Kyle all about? Like what's happening?
Yeah. Absolutely, man. Well, it's such a pleasure to be on your podcast, obviously, for sure, just to be able to give insight. I'm doing a little rebranding, kind of getting some things back together. So originally, I did have a radio show or radio podcast on Amp Radio, which was a variation of Amazon. They had like this whole platform set up to where you can go have the free press to be able to talk about different things. And so my biggest thing, in terms of what I do is I'm a licensed financial professional. And,
Okay.
what does that mean, right? We help families understand the components of building and estate planning for themselves moving forward, right? A lot of people get the variations between a financial planner and a financial professional as two different concepts. But at the end of the day, we both have distinct things. The biggest defining factor I would say in between what we do is that a financial planner, they're usually securities licensed, and a financial professional, we usually are based around life, accidental death, and health insurance, right? So we focus on the context of insurance. And so I tell people at the end of the day, when you think about it, we're both here to do one thing, right? And we have a fiduciary responsibility to be able to support our people and to support our clients, right? Whether that's with estate planning, whether that's with legacy building, whether that's with business consultations, whatever it is, we figure out and we create a strategy that's going to best suit them, one, financially for their future, and two, to be able to set them up for the best opportunities to be successful. And so that's what we do. And so my podcast, I'm starting all over again, just because App Radio was kind of put to the side, and I lost all of my content on there, and it was unfortunate. But hey, we have a saying in our brokerage: we don't panic, we pivot. And so we're just really excited about what's to come. And the platform that I'm building is really, really honing in on the importance of planning. And so we're talking about what we're doing. As far as my podcast goes, it's called Unsolicitedly Manifested. We just pre-recorded 4 episodes, actually, with myself and a couple other people that are in my field of work, just talking about strategizing, wellness, and just overall just growth, right? Because I think those three are one of the same. If your mind is not right, your body is not right, your money is going to be right. So I definitely think that they're one of the same. So it's a multitude of many different things that we're going to be talking about. I'm really excited. We actually have our first episode coming out next Tuesday.
Okay.
So it'll be really, really fun. Just the time just to let loose, man. I feel like we make these podcast things really mundane, like, hey, we have to talk and be direct and about, what's fun and, what I'm doing in my life. We always have to just say, hey, this has to be perfect. And that's not the case with this podcast, at least.
Yeah, yeah.
It's
No, I
really
mean,
for people to let loose.
this
Yep.
one's
Fair
certainly
play.
not perfect, man. It's always a learning
Right.
experience for me on and the podcasting
Right.
thing isn't it's like not a direct type of moneymaker of any sort. It's more of
Right.
just an educational platform and education for me as well. So yeah, I enjoy the conversation, just shooting the breeze and talking shop and all the different things. So all right, let's talk then on in your profession, right? So explain to me, you're doing some estate planning. Are you using life insurance products for estate planning purposes? Or are you having other,
Correct.
what
Absolutely. So
levers do
all
you
that
have?
and more.
Like,
And so just to, like I said, just to give you a base point, I'm a licensed agent. So when we break it down to the context, no one grows up and say, hey, I want to be a life insurance agent, right? We're usually, in my full-time job, obviously, and I love doing this, but in full-time, I'm also a full-time police officer, right?
okay.
So I work in San Francisco. I'm a San Francisco police officer. I love what I do. I've been, a police officer well over 8 years in counting. But what really got me into this business and what really drove home for me the importance of planning is I lost my grandfather to pancreatic cancer / COVID in 2019. And one thing about that and what struck, kind of what struck a thought in mind was that unfortunately my grandfather was not prepared. So two income household, they lived, on a golf course. My grandmother, she loved where she lived, they grew up in a pretty rough neighborhood. And for my grandfather to work, 20 plus years, he was a roofer, he was, part owner of the company. And unfortunately, all the income that he was receiving, essentially was not going towards his retirement. And so to leave my grandmother just suddenly, to pancreatic cancer, he had beat cancer, several years prior. He had liver cancer, stage 4, beat it, and then it came back. It was just like, and pancreatic cancer is one of the most aggressive cancers that you can possibly have. And so one thing about it was that, just fast forwarding, my grandmother was not prepared, right? No life insurance, no retirement, no income. And for you to have, a $700,000 to $800,000 home to still be paying mortgage on, especially on a fair income like my grandmother had, it just wouldn't work. Right. And so that was what really struck my interest in really getting into helping people strategize and understand the importance of having an estate plan and having life insurance and having these incomes in place. And we kept losing family members, kept losing family members. And unfortunately, I lost my best friend. He was shot and killed. And it just from there, it really struck an interest. He said, look, moving forward, none of our family are ever going to have to go through that again. If you leave it up to us, we're going to make sure that one, they're insured, and two, that they have a strategy and plan in place, God forbid they pass away, and to leave their family with a legacy. So
Okay.
that was the start of something begin. That was the start of something.
So let's touch on that then. So what are the levers that you have that you can employ with your current profession and the conversations that you have with family members, friends, and clients in order to properly establish? Because we have a lot of real estate professionals listening to the show, right?
Right.
So like, I guess the levers that you have that maybe you could recommend that here at a base level, you need X, Y, and Z.
Absolutely. And the great thing about it, Randall, is that we do work with a lot of investors too, right? A lot of people are like, they get this misconception that I tell people all the time that financial planning and real estate don't go together. Financial planning and investing don't go together. And they actually do, right? And so when I tell people, when we conceptualize real estate and financial planning, a lot of our investors, they say, well, either they like it, right, or they don't like it. There's no in between, right? Either they want to have a life insurance policy and they know that they can build cash value to be able to utilize it for other things in their business or in their financial or in their real estate endeavors, or they say, nah, I'm just going to stick simply to real estate. So when we're talking to people, especially real estate agents, I typically like to work with investors because why? Real estate investors. And there's a huge, and I'm sure you can probably attest to this. There's a huge, difference between a real estate agent and a real estate agent who's a real estate investor, right? Because
Sure.
you get a lot of these guys, a lot of these gals who are new to the real estate field, and they have no clue about what options or what investments options are out there. So what I usually tell people is, look, when we talk about buying real estate or utilizing life insurance as a tool to be able to now fund your real estate options or real estate investments, it's a great tool. At the end of the day, we have to consider two things, right? Life insurance is a guarantee, it's a benefit, right? But it also gives you the benefit of utilizing income while you are alive and when you die, right? So just say, for instance, you have a family member that has a household or that has a house, worth $500,000, right? And they say, oh, I have my primary home and I have my secondary home, which I consider as an investment property. One's worth 500,000 and the other's worth 500,000. Now, when we consider it, when that family member dies or that head of household passes away, and the wife is left with the kids and a mortgage and a car note and all these things, how is that income, how is that stability going to be replaced? Right? She doesn't know how to handle essentially how to handle the secondary home or the retirement home, and she's paying the mortgage, but that's even an overhead for her. So what we tell people is, why leave your family with an issue, right, when they're already grieving, when they're already going through it, when you can already have an estate plan or have a strategy in place in terms of a trust or irrevocable trust or a will, or even having just something in place to leave them with financial stability. So what I'd say is, okay, well, if I know, right, if I know that you have two homes worth 500,000, my goal is to set up a plan or a strategy that's going to, one, be able to now replace that income, pay off those two homes, and leave your family with some extra income to be able to support them financially, right? So if those two homes are worth $1 million in total, my goal is to at least get $1 million on the father and $1 million on the mother. God forbid something happens, to be able to, one, pay off both homes, and two, to now be able to leave them with some income that's going to now pay for the bills, pay for the car notes, and things like that. And so when people put it into context like that, they're like, well, I never really thought about it. I just thought as my home as an asset that I can utilize. Yes, you can utilize it. Yes, you can refinance. Yes, you can get a HELOC. But the thing is, you're still paying interest on that income, right? You're still paying interest when you're refining or when you're utilizing that home as a secondary income source. So it's just all about strategizing. I always say life insurance is not the one benefit, but it can be a tool for success in your financial future. So
Yeah.
that's what it comes down to.
All right. You touched on a couple of things there that I think one needs some clarity, and then two, I want to dive into a little bit more.
Absolutely.
So $1 million policy, is that term, whole life? And if you could, for the audience, explain the difference in the two.
Absolutely. So there's three, right? So there's three main concepts of life insurance. So you have term, you have whole life, and you have universal life, right? So there's three. So when we talk about term, obviously it sounds like what the idea is, term life. So that means that your life insurance policy gives you a coverage for for a set amount of years. So it can usually ranges in between 10 years of coverage, 20 years of coverage, or 30 years of coverage. That's a term life. So there's no permanent value or cash value that's being built in the policy. God forbid you pass away, your family gets the death benefit if you pass away before those 30 years. But with term life, 99% of people typically outlive their term life policies. Unfortunately, that's just what it is. Because why? They either don't know how to churn it, or they don't know how to utilize a term life policy to be able to give them the benefits. So 9 times out of 10, when people say, hey, I just got life insurance, I got a term life. But yeah, 99% of people are going to outlive that policy. So then when we get into the other two, which are whole life and universal life, those are permanent life insurances. Meaning what? One, you can build cash value in those policies, meaning tax-free cash value under tax code 7702 and 72E, to where you are paying with after-tax dollars to build cash accumulation within your policy, right? And then with whole life, you get the benefit, right, of having a guaranteed death benefit, meaning when you pass away, your family will get a death benefit. Let's just say 100,000, 200,000. That death benefit is going to come to your family without penalties or taxes being attached to it. Same with universal life. Now, there are different variations of universal life that you can utilize, like IULs, right? Index universal life policies, or VULs, which are variable universal life policies. So it's all a matter of how you set up that policy. But the great thing, like I said, between a permanent life insurance is that you get to build cash value. You get a living benefit, which means you get to utilize your benefits. Like if you have the chronic, critical, or terminal illness, if you get sick or one of those things, and you have full access to your money, willing that you have cash accumulation built within your policy to utilize it for anything that you want to. And that's why I love it, because you can take that money, utilize it, instead of going to borrow from the bank at 9-10%, you can now utilize it to take a partial loan or a full withdrawal from your policy to utilize for your current business, to integrate that as without penalty or taxes being applied. So that's what I love about it the most.
Okay. All right. So let's touch on that then. So same scenario, or as simple as possible, just so that we can make this as easy to understand as possible. So
Right.
I get let's call whole life, and it's $1 million policy because it covers those two houses that you were talking about. For me, the wife, right? Two separate policies, I guess. One, what's the initial cash required Because from my understanding, there's a large down payment essentially that you need up front. How much money is that typically? And if it varies, then it seems like the premiums go up on a monthly basis. Is that correct? The less you put down, so here's how I've heard somebody describe it to me.
Absolutely.
And I want you to, I guess, refute it or give me your feedback on it. So you're paying interest on money before you actually get to draw it down, and you're paying for the benefit of using your capital. Kind of, this is how somebody's presented it to me, because I've looked at these policies, man, and I'm like, okay, I get them, and I probably have a term. It's like I don't know, $1 million policy of some kind, and
Right.
like, that's it, right? So,
Right.
I've looked at the other side of it too. So,
Right.
explain to me what you, I guess, counter that argument of like having your money. Obviously, you get the death benefit if you have the policy, so that's the benefit. But if I'm going to go borrow, like you said, I've got cash value sitting there and I can borrow against that. What rate would I be paying then on the money that I've already put into this policy? So if I put, in this $1 million policy, if I put $100,000 down and I'm paying $1,200 a month or whatever, then I don't know what that number would be. How much would it cost me to then borrow that $100,000 back out?
Right.
You know what I mean?
So
anyway.
So no, I absolutely understand it. And to your colleagues' defense, that is true to an extent, right? And obviously, when we talk about building or essentially paying in advance of what the strategy would be, there's a lot of different variations. So just to keep it simplistic, when we talk about life insurance in general, right, it can be this very convoluted thing for a lot of people, and it's really not that, right? So it can vary, right? Obviously, you said, if you're putting in $1,200, I tell people like this: when we're talking about what are you utilize, so two things you have to consider: what are you utilizing the life insurance policy for one, right? And two, where's your current financial situation to where you can afford something that's going to, one, be beneficial for your family or be beneficial for you, right? Because some people say, hey, I want to just use this policy just to build cash accumulation, right? I don't really care about the death benefit. That's not really my words. Or you have some people say, hey, I want as much death benefit that I can get for my bang for my buck, right? So it varies, right? It also varies by your age. It varies by your background associations. They even look as far as, your medical history. They look at your, criminal history. They look at a lot of different things, because at the end of the day, this is an investment with the company, right? It's a contract. It's a contract between you and the company that sets standards to say, hey, as long as you meet these qualifications, we can now approve you for this rating. So when we talk about it, let's just say, for instance, right now, right, when we talk about borrowing, so there's two options. When we talk about borrowing money from the cash value of your policy, there's two options. So there's either a withdrawal, right, a partial withdrawal, or a full withdrawal, or you can utilize this option as a partial loan from yourself. So it's just basically like you're borrowing money and you're putting it back in an instance of you paying that interest back. So for instance, right now, I would say on an average cash value life insurance policy for what you're borrowing typically ranges between 3 to 6%, right? Or 3 to 5%. It just depends on the company, right? The product that you have. So I can't really say, hey, this is going to be set in stone for Randal as opposed to me. It goes with a lot of different variations, right? So obviously, when we're talking about borrowing, 3 to 5%, but the great thing about it is that I typically say it can be a wash, because why? At the end of the day, right? Let's just say you have $50,000 in your cash value life insurance policy, right? And you say, hey, I need to borrow $15,000, for this property that I have to buy, rehab, renovate, and rent it out, right? So I'm $15,000 that I got to put into the renovations of the property. Great. Instead of going to borrow that at a 6 to 7 to 10%, interest, why not go borrow from your life insurance policy to where you're now paying 3 to 4%, right? And then the great thing about it, as your policy is performing, let's just say right now, the average return, or the average interest on terms of what your money is growing at right now is usually between 6.4 to about 6.5%, right? That's the average return, right? So let's just say you go to borrow that money. Let's say you take out 3%, you take a loan from yourself. Let's just hypothetically say you take a loan from yourself at 3%, right? It's a wash because now your interest is growing at 6%. So you're still earning 3% on your money as that loan is being taken out. So it's more or less your money is gaining interest and you're still able to borrow from your policy of the 15,000. Right. And a lot of people say, well, yeah, you're still taking income, you're still doing this, you're still paying back. But I say, yes, at the end of the day, you are. But my thing is, would you rather go pay 7 to 9%, or would you rather pay yourself back, earn the interest, and still be able to have cash accumulation grown within your policy? Right. So that's where the context comes into this being, and then on top of that, with that being said, you're not paying taxes on the money. You're not paying any penalties, because why? You're paying your policy, and the contributions that you're making in the monthly premium payment is now after tax dollars. So that's why in a life insurance policy under tax code 7702 and 72E, you're able to build tax-free income within your life insurance policy, right? Because now you're paying with after tax dollars, and now the associations of where your money is growing is not attached to the actual stock market. It only mirrors. So when we come down to it, that's the base points of how, of how it typically works.
Got it. Okay. Yeah. So I mean, I've heard there are a few life insurance guys, life co guys that are going out presenting this type of policy for real estate specifically because
Right.
you're able to borrow against it. And I know several people that have done it, and there are benefits to it for sure. So again, when somebody's coming to you and they want to set something up, and let's keep it with real estate specifically because that's the audience. So
absolutely.
like
Absolutely.
what's the minimum that you're looking at, and what are some things that people can ask either their financial planner, financial advisor, in order to set them up, or their attorney even, when they're going through some estate planning with their attorney, in order to get the most protected coverage, I guess, in order to do it properly.
Right. So there's different variations, right? So when we're talking about real estate specifically, I asked them one thing, right? What are you utilizing this for? Absolutely. Like what I just said in the beginning,
Okay.
right? What is this life insurance being set up for, right? What is this policy what is this strategy being set up for? Is this just for you to leave to leave a legacy for your family, for you to leave income for your family, death benefit for your family? Or are you utilizing this to have cash value to be able to pay, for renovations, to be able to have corporate cash for yourself, is what I like to call it, right? Corporate cash.
Let's focus on that example then. Yeah.
Yeah,
Assuming
absolutely. Yep. So corporate cash. So for instance, right? So you may say, hey, Kyle, I don't have anything set up. Of course, I have, my assets as far as my home. If I pass away, I'll leave my family, let's just say with this property, I have a portfolio of 6 homes, let's just say between California to, I don't know, I don't know, the Midwest, right?
Yeah.
And I said, that's absolutely amazing. What I tend to ask, what the follow-up question, Randall, is after that, what do you owe on these policies? I mean, what do you owe on these homes, right? Because at the end of the day, like I said, your family is grieving. You don't want to leave them with debt that they already have to configure or have to pay. Because why? If you don't pay it, obviously the bank is going to own it, right? So what I ask them and say, okay, what do you owe on these homes? They say, hey, I owe, let's just say 500,000. I say, okay, well, great. Let's look at 2 constructs of what you're trying to do, right? So if you're saying, obviously, money is, contributions are going to be a factor as well. If you're saying, hey, I'm only working on a budget of $500, it's going to kind of be a tight fit because we're trying to squeeze, we're trying to put, a circle through a square, and that just won't work. You know what I mean? But we're going to find a strategy, right? Because it's not how you start, it's how you finish. So then when we go on the other part and they say, okay, well, we have the idea of what we're going to strategize for you to leave your family a legacy. But now let's talk about the business component, right? What are you utilizing this for? Okay, to have corporate capital, meaning what? If you wanted to go, buy another piece of real estate, or if you wanted to invest in another property, or if you wanted to, start lending out or, being a private investor, you can utilize this. And like I said, some people like to call it infinity banks. Some people like to call it, becoming their own banks, whatever you like to call it. But I just say having the access to beneficial cash. And the great thing about a life insurance policy, as long as you have cash value within your policy, you can utilize that cash value for your benefit. So a lot of real estate agents, they'll come to me, they say, hey, Kyle, I want to utilize this policy. I don't want to have too much cash. I don't want to have too much death benefit, because why? I don't want the cost of insurance to eat away at my cash value, right? Because when we tell people there is a cost of insurance, right? There is a cost to keep the policy in place that the company utilizes from the premium that you're paying every single month. So what I tell people is, let's just say you're paying $1,000 a month. Your cost of insurance is $200 per month. You got $800 going towards the cash accumulation in your policy. Let's just say minimum growing at a 6.46% interest, right? Or worst case scenario, if we're in a down market, 3%, or worst case scenario, 0%. But the great thing about it is that there's always a floor, so you never lose on the money that's growing in your policy. So a lot of real estate agents, they say, well, that's great. I can utilize this to pay for things, to rehab the property, to buy real estate. And some people, I had a client 6 months ago, he actually took $100,000 out of his policy because why? He front loaded, right? He fully front loaded his policy to meet the cash accumulation that he would utilize for him to now go and benefit to be invest in real estate. So when it comes down to it, those are the two major things. What are you getting the life insurance policy for, and how is it going to benefit you in the future? And of course, what are the contributions that you're going to be making? Yeah. Because if you're putting $1,000, let's just say, into a $500,000 life insurance policy, you're going to see some cash accumulation in the policy, right? Yeah. Because of the compound interest that it's growing at, and how it's growing, and how the money is being diversified in the, with the index strategy that it's growing.
Yeah.
So those are the main two ideas when we're talking about real estate specifically.
So when you had one of your clients, do a front load, what does that mean? What does that look like?
So a front load, so let's just say, for instance, let's just say a max funded IUL product, right? So that's usually, that's one of our flagship products, is the Index Universal Life Policy. And the great thing about what I love about the Index Universal Life Policy is that it gives you a couple of things, right? It gives you a flexible premium, which means what? The difference between a whole life policy and an Index Universal Life is that with the whole life, you pay one distinct premium each month. So if it's $85, you pay $85 a month. But with a Index Universal Life, you get flexible premiums, which means what? If your minimum payment is, let's just say, $150, as long as you support the minimum payment for insurance, anything in excess of that goes towards a cash accumulation. Let's just say 1 month you're like, hey, I want to pay $400 this month, or next month I want to pay $1,000. You have the flexibility of being able to, and we can go into a lot of more context with that, but you have the flexibility of being able to add more money into that policy. Of course, as long as it's supporting the MEC, which is the modified endowment contract, that's basically the allotted amount that you can't go over. And if you go over that amount, then the IRS starts to look at that asset as a taxable asset, right? So that's why we typically like to keep it between that standard and say, hey, your MEC, let's just say, for instance, that client's MEC might have been $70,000, on the year, right? So they have up to $70,000 what they contribute into this policy before it's looked at as a tax. So that's the great thing about it. And so when we utilize this, a lot of people say, okay, well, I'm going to put this money in, my money is growing. And when we talk about a max funded IUL, right, getting back to that idea, we understand that if we put $1,000 in there each month, right, and the numbers can differentiate, right, because your age as opposed to my age is going to be different. But let's just say for a $500,000 life insurance policy, they're putting $1,000 in. The cash accumulation that you're seeing, especially for someone that's my age, that's 30 years old, is going to be much higher, and you're going to see it much faster than somebody that's putting in $1,000 a month that's 60 years old, right? Because of course, their age, their health, their risk factor, if they have any mental disabilities or anything like that. So the company looks at that, and that makes an instance on, one, what the cost of insurance is going to be, and two, how much of that cost of insurance is going to eat into the cash value of the policy. So that's what it comes down to. So I would say the biggest thing is really just getting with a financial professional and seeing what works best for you and running the numbers. Because like I said, it's not a one size fit all option, right? We can always play with the numbers and see what best suits your situation. And we can come up with a strategy that's going to help you meet the standards. Now, if you're pouring in, let's just say you front load the policy, meaning you put $5,000, $10,000, $20,000 from day one, of course, you're going to see cash value right away, because why? You're fully funding this policy to its max. So now you're going to see returns that are going to be much higher as opposed to you paying $100 or $200 per month.
Yeah.
Right.
So, yeah, for sure. Okay. Have you invested? Because you're in the police force, right? So, but
Yes.
you're doing this insurance and financial professional and such. So, how about investing? Have you? I mean, you mentioned burst
Right.
strategy. You obviously understand some of these things and the concepts on
Absolutely.
the. Okay, so tell me about that.
Absolutely, man. So, I mean, of course, pensions. I have a pension, right? It's great. I mean, it's decent, right? I had deferred comp. It's decent. I got rid of it because why? When I actually got into low cost index funds, 6 or 7 years ago, I started seeing, I'm like, dude, what I'm paying for this in terms of the fees and the taxes and things that are going to be deferred down the road, I might as well invest this money at my own regard, do my due diligence, right? And do the things that I need to do and eliminate that 3 to 6 to 7%, fees that they're taking from me and just put it towards my own, put it
Yeah,
towards my own investments. And so I think that was the start of it for me. Because let's just be honest, especially working in the city and county of San Francisco, a lot of people don't know what they don't know, which is why they don't have, right? They're just not informed. And so when I talk about people having great investments or making money or becoming a millionaire, I don't believe in luck. I just think it comes down to preparation, meeting opportunity, which equals success, right? If you're not prepared for the occasion, you're not going to have the best opportunities and you're not going to be prepared for the opportunity when it comes. Just like I'm sure for a lot of people, after the 2008 housing crisis, a lot of people were like, well, I'm not going to buy a home because it's not going to benefit me in the future. But then when you have those savvy investors who know the market, they say, well, hey, yeah, the market's down. I can buy these houses at a low rate as long as I'm cash flowing for now and I can get through this turbulent time. I know coming out of this recessionary period, I know coming out of this bad time, these houses are going to increase in value and I'm going to be able to now increase the valuation of the rent that I'm getting every single month. Right. So that goes with preparation and having the strategy in place to put you in the best position. And so for me, you know, I don't believe, like I said, I don't believe in it's a one size fit all option. Like for me being a licensed financial professional, I don't believe that life insurance is the only way. I just think that it's one key to you investing in your future. Just like me, I look at fixed, variable, and indexing strategies, right? When we talk about variable strategies, we can talk about Roth IRAs, we can talk about 401ks, we can talk about a bunch of different things. Or when we talk about fixed options, we can talk about certificate deposits, we can talk about putting your money in a high yield savings account,
yeah,
whatever it is. It's
uh,
just a matter of what works for you.
for sure. But I'm asking what works for you
Oh, what works
specifically.
for me? I'm sorry.
Yeah, what do
So
you
what
would?
works for me, to be honest, I would
Yeah,
say the majority of what I'm staked in is life insurance, right?
yeah,
Because I know the guarantees are there. I know that God forbid if I die today, I'm leaving my daughter with well over $4 million in non-taxable income,
yeah.
right? Leaving her with tax-free income. And I know that I can utilize these tools to benefit me while I'm alive and when I'm dead and gone.
Got
Right.
it.
And so that's where I'm at. And that's what I'm investing in right now. Of course, real estate is another thing that my wife and I do. My family has been in-home care, in-home care service support for elderly people with mental disabilities for almost 20 years now. And so a lot of that has been contributed to one, buying real estate and utilizing those facilities for in-home care support. And so that's been a very lucrative business because let's just be honest, with everything that's going on with baby boomers and people getting older, especially people like my grandmother, they're getting older and they're going to need services when they do get older. So it's a lucrative business. It's very low maintenance, I would say, in terms of what the turnover ratio is, because a lot of these people tend to live in these facilities for 3 to 4 years minimum, right? So if we're keeping these facilities and we're utilizing these facilities to be an aid to people, now not only are we getting the full benefit of the real estate, but now we have two businesses. We have the real estate business, right, which is the rental property, but you also have the in-home care business, which is now funding, right, or renting or paying the rent for the established facility base. So
Yeah,
that's where I have my money. And of course, I have my money in a little bit, and I hate to say this, I hate to say it. I have a little bit in Bitcoin, a little bit, right?
I
That's
wouldn't
not
hate to
full
say
for,
it, man. If
yeah.
you're bought right,
But it
you're
is, but
sitting
it's
pretty
true,
right
right?
now.
Right. It's the new day and age gold. And I believe that, right? I do believe that it's going to have store value, right? I just think a lot of people just don't know too much about it. That's why they're just scared to invest in, right? And
Oh,
so
yeah.
the more you
Mhm.
learn, the more you strategize, and the more you plan for it, the more you'll be more equipped to understand these concepts. And so that's where I'm at right now, and obviously, the stock market, like I said, low cost index funds, real estate, of course, cryptocurrency, and then of course, life insurance as far as my diversified portfolio.
Nice. So you have invested in group homes, it sounds like your family does group homes. Yeah. So we looked at that.
So ARS, so adult residential facilities. Yep.
Yeah. So that's a very interesting business model. We had applied for the license that you need in order to do that. And we were looking for homes, but I mean, you can buy like a 3-bed. The issue that I saw, it was just actually running the home, like the liability associated with running the home. And that was like one of the biggest things. But anyway, kudos to you guys for having that and setting it up. It is a much needed business model. I
appreciate that
in type of property. So, hey man, I really appreciate you jumping on. I think I'm going to throw your contact information in the show notes. If you are out there and you're looking for some strategies and some ways to, one, cover your life, make sure that you have insurance and you are covered, I would highly recommend reaching out to Kyle. He's a wealth of information, as you can tell from chatting here. We didn't even get a chance to really talk about you being on the police force in San Francisco. But that maybe sometime I can catch up with you offline, because I'm very curious about that as well. But
absolutely.
Hey man, again, I appreciate you jumping on, sharing your knowledge, sharing your information, and I wish you the best of luck. So,
absolutely. Same to you, brother. Well, I thank you for having me on. And like I said, this is a platform to where you're letting people spread their word and spreading their information. So you can't beat that at all.
Yeah, man.
And like I said, if you guys have any questions or concerns, please reach out to me. And if you want to know any more about my story as well, I'd love to talk with anyone about that. So thank you for having me on, Randal.
Oh, for sure. Thanks again. Catch you guys on the next episode.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.